Hello, everyone. Good afternoon. Thank you for joining us today. Uh, we wanted to talk about what the RBI has planned for 2024 because, as we all know, monetary policy does influence our framework of how we make decisions. And this is the first policy that we're going to have this year, or the one that happened yesterday. And I think the key thing to remember is that. Uh, So this was the first policy that we've had in 2024, and there's been a lot of wait and watch on both the Fed policy as well as the RBI policy, primarily because uh, that has been giving markets some guidance on what the policymakers are thinking. It's not necessary that the market view and the policymaker views are actually lining up. So this is one of the reasons why we chose to do the webinar on this topic today. So I'll go through what happened in the policy, what it means in terms of an outlook for 2024, and how you can also structure your investment decision framework around this. At the end of the webinar, we can have some time dedicated to Q&A. So I'll be happy to take any questions that you have at that point. So you can just type in your questions in the chat box or in the Q&A section, and we'll get to all of that through at the end of the webinar. So, without further ado, let's talk about what the RBI has planned for 2024. Right. So, the first part I'm going to dedicate to decoding the policy statement. So, what did they actually say on 8th of February? And what are some of the updates? So, those of you who've been following the news would know that they didn't really change the repo rate or any of the policy rates, but there were some highlights that I would like to spend time on. The first is that we've had one more year of strong growth. So, the projection for this year as well as next year in terms of economic growth is upwards or equal to 7%. And this would mean three consecutive years of high 7% sort of growth, right? So this growth is what the markets have been sort of feasting on, where you see a lot of exuberance on the equity side because companies that have delivered good growth in the last couple of years, all of the valuations are being adjusted based on the recent performance and the expected 1 year growth trajectory. So the second thing is the RBI is quite conscious of the fact that the markets are quite positive, that India is, even in a global context, one of the few economies that has continued to perform quite well when you're seeing a global sort of slowdown occur. The second point that we would like to spend some time on is how the RBI is actually going to manage inflation, right? So, what markets are thinking of in terms of inflation is that inflation expectations are well anchored. We've made a lot of progress from, say, 2021, 2022, when we had really high inflation, to where we are today, which is below 6%. But the RBI is quite keen that they are going to look at a target of 4%, and that we shouldn't take things for granted because repeatedly in the policy statement they do talk about food inflation being a pain point and having a certain level of unpredictability associated with it, right? So if you see your headline inflation, you had like a lot of volatility there, and all of the volatility or most of the volatility is attributed to your food prices. So when you have these two situations running parallel to each other, where you have an RBI which is focused on bringing inflation down to 4%, and we're not there yet, we're below 6%, which is the upper end of the target. You have a lot of moving parts in the inflation projection framework, and you have some risks to food inflation going both upwards as well as downwards. I think they have explicitly stated that they want to take a data driven approach, and they want to be quite vigilant, or they want to be quite focused on month on month, where is our inflation number, are we consistently coming or moving towards that 4% target. The third thing that the governor spoke about is about how markets are sort of front running the central bank policies, right? So there is an expectation that, say, in the US, the Fed will have to cut rates, and the markets are reacting to that in advance of the event actually happening. So you see that the markets are moving one step ahead, even though the Fed has not yet taken that step. And recently, if we look at this week's data that has come in, where the chairman of the Federal Reserve actually spoke about where policy is heading, he's been quite balanced in his view, and he's come out saying that we are cautious of sort of easing up monetary policy a little too early, right? So there is a statement, or there is an interpretation, that maybe March will not be the first rate cut. Uh, so this is something that we need to keep an eye on. Are the markets getting ahead of reality? If they are, how do we manage our investment decision framework according to playing it safe, as well as not really compromising too much on either risk or return? The fourth point that the governor talked about was about active liquidity management. So if we look at the policy stance, which is withdrawal of accommodation, what the governor has said is essentially that that means you're unwinding some of your excess policy. You're going to bring liquidity into like a neutral or a deficit zone, and that's where we've been for a couple of months. But the RBI has also stepped in to infuse liquidity into the market, and you will see that this is the way that they want to approach the equation. That ideally you would like your um, overnight borrowing rate as well as your repo rate to be in line with each other. But if for whatever reason there are mismatches and imbalances, then the RBI has committed to stepping in to manage liquidity on a more active or a proactive basis also if required. And in terms of achievements, I think you would see that most of the policy decisions that have been made by the RBI over the last few years has brought in a certain level of macroeconomic as well as financial stability. And that is the core of what they want to do in the future as well. So this is where the focus is going to be, right? So, and you'll also see this in terms of proactive response to signs of stress within the system, right? So the RBI circular where they said that they're going to change the risk weight assets on unsecured loans was a proactive measure, right? And the RBI's priority, in this press conference, there was a lot more going on about Paytm than let's say specific policy actions that the governor had announced on 8th of February. So what came out from that discussion is that there is going to be an FAQ that's released on Paytm in the coming week, and that the way the RBI looks at protecting the financial system and regulating it is to put consumer and depositor interests on top, and that in turn creates the priority for financial stability. So both go hand in hand. Um, and what we see is that our external sector has also been resilient in the sense of us being able to manage our current account deficit really well, and how that trend is to continue for another year or so. And if we look at, let's say, how the rupee was in 2021, 2022 versus 2023, we are seeing a lot more stability on the rupee side as well. So these were the 9 highlights from the policy that we wanted to walk you through. And now I'll talk about the metrics of the policy as well. So you see that your policy rates, the repo is at 6.5. So that's been unchanged since February last year. So for the last 1 year, we've been at the same policy rate. We have also been at the same policy stance, which is withdrawal of accommodation. And this stance has been around for much longer because we were in a phase of increasing interest rates prior to this long pause. And in that phase also, we were broadly in withdrawal of accommodation. And if we look at where our foreign exchange reserves are today, we're at 622 billion. That's a pretty good number. So with this rupee stability, etc., you're improving CAD. So on a macro as well as policy metric front, we're doing quite well. So I just wanted to also look at how the committee's views have changed since, say, September. So if we look at each member, They have been in withdrawal of accommodation from September 2022 till about February this year, with the exception of two people, Ashima Goyal, who briefly looked at a neutral stance, and Mr. Jayant Verma, who's been neutral for quite some time, right? So there is some level of, I guess, divergence in policy views, but not much, right? And this is also just a trajectory of how people voted over the last year or a year and a half. So if we start in September 22, I'd like to bring your attention to the bottommost row. So this is the repo rate that was after the policy was made. And the row above that tells us what the policy rate was before the policy meeting. So there was a vote to increase interest rates by 0.5% in September 2022, with Ashma Goyal being the only committee member who wanted to keep it at 5.75 instead of doing a 0.5% rate hike. Then we had the next rate hike in December 2022, where pretty much everyone except Mr. Jayant Verma voted to keep the policy, voted to increase the policy by 0.35%. And then after that, Mr. Jayant Verma has pretty much chosen to keep the policy stable, as has everyone else, but he has voted to change the stance, right? And in the most recent decision, that is like our February 2024 policy, Mr. Jayant Verma voted to cut the repo rate by 0.25% and maintain the stance at neutral. So we are seeing some level of divergence that is consistent over a period of time. And it is healthy to have difference of opinions within the committee as well, because each person is considering a different set of factors, and that allows us to make more holistic policy decisions. So now that we've gone through what happened, what actually comes next, right? So let's look at how inflation has behaved in the last few years. So prior to the pandemic, we were actually heading into a high inflation zone. So if you look at the inflation numbers from say June 2019 to about March or March 2020, you see that we were on a steep rise and we had inflation even at 7%. There was a need to bring inflation down in the pre-pandemic era. Then once you had your lockdowns and everything, your inflation actually automatically reduced. And you had a period of quite low inflation where you got to almost the policy target of 4%. And then you know that in 2021, end of 2021, 2022, you had some disruptions coming in, especially with the Russia-Ukraine war in February 2022. And that caused a huge inflation spike. You also had all of these supply chain issues playing out at the same time. So then we went into a period of inflationary cycle. And from 2022, there's been a consistent sort of effort to bring inflation back to normal. And the last, I think if we look at the last 1 year, our inflation numbers have actually been quite volatile, because there are times where you're closer to 4%, there are times where you're closer to 7%. A lot of this has to do with food, fuel, as well as like other metrics. But so as you can see, there is no clear direction of inflation movement, and this last mile effort to come back to 4% is going to take longer from the RBI's perspective, or requires a more vigilant approach, as they termed it. Right? So what are the risks to inflation? I think the first is that food inflation has been quite volatile. So you've seen some months where you have a lot of food inflation. You've seen some months where there's neutral. You've seen excess supply. But what has happened is, the reason why we've not felt inflation as much as we would have is because there have been a lot of supply side interventions from the government. You can go back, look at news articles, and you can see how much has actually gone into stabilizing food prices, right? So we can't take this for granted, even though it's not visible. This is one big risk to inflation. And on the food side, we need to track two things. One is the monsoon, and the second is our reservoir level. So last year there was a lot of talk about El Nino and a drought and how that would affect monsoon output. And that has been managed with good supply side interventions. But what comes next, what is going to happen in 2024 is not necessarily a repeat. And we're also lower on reservoir levels this year. So, and that's a very important input in terms of agriculture as well as your crop output. The second is that you're seeing supply chain disruptions. So if you're looking at the news, you'll see a lot of data on the Houthi rebels and the Red Sea crisis and what is going on. And this again would affect, because if we look at India, oil and gold are our largest import bills, right? So any volatility in oil prices is automatically going to translate into some volatility on our inflation numbers. And if oil gets rather expensive, then you're going to have some issues on other macroeconomic parameters like your current account deficit, your trade balance, as well as inflation. Uh, then the third is the demand for commodities. So as there's been a lot of talk about global slowdowns, you're seeing China show some green shoots in terms of coming out of that deceleration cycle. So if there's a demand for commodities, then again that could change certain dynamics and pose a threat to inflation. So what are the priorities for the MPC? If we look at what they've talked about in this policy, the major thing has been the rate hike transmission. So they've talked about how they had increased interest rates by almost 2.25, 2.5% over the last couple of years, but you're not really seeing that translate into interest rate changes at the end level, right? So whether it's in terms of like deposit rates, whether it's in terms of loan rates, that transmission hasn't been full according to the RBI. And that is something that they want to ensure, because the full transmission of rate hikes could help in turn achieve this target of 4% inflation. And again, this is no, even though the RBI has a flexible band of 2 to 6%, they are not looking at keeping inflation below 6%. They're looking at bringing inflation to 4%. And this is very similar to the kind of language that the Federal Reserve Chairman, Mr. Jerome Powell, has also been using, where he's been talking consistently of bringing inflation back to 2%. So all central bankers uniformly are looking at this inflation movement as a challenge, where they need to really stick to the targets that they have set and to do whatever it takes without, compromising on growth or without causing other problems to bring inflation to those junctures. Right. So with respect to financial markets, the policymakers again are very conscious of premature easing. So they don't want to look at easing financial conditions unless it is warranted, right? Because there is still some work left on the inflation management side. And like I mentioned right at the beginning in the highlights, participants are front running your pivot expectations. So if you look at even the bond price rally that happened in the US markets in December, for example, you'd see, if you just look at the data 2, 3 days before the Federal Reserve meeting versus like a week after the Federal Reserve meeting, how much your 10-year Treasury, how much your 10-year US Treasury responded to these changes, will give you a picture of how markets are anticipating what central bankers are doing, even though central bankers have not really committed to a specific path. And from the central bank view also, there are enough of moving parts to not have a straightforward guidance on what is going to happen next. So if you see the language that they're using in terms of, we want to have data-driven policy, or we want to do a meeting-to-meeting assessment of factors, you know that policymakers aren't really thinking too far ahead, because there are a lot of unpredictable elements in the mix. So we also need to begin to think ahead about how to approach 2024. So if we look at the RBI governors, one of the key statements in Thursday's policy, you see that he's talking about how India has performed really well in the last few years, and that growth is still accelerating. So then the next year, at least, the projections are fairly positive, and inflation has moved down, but inflation hasn't moved exactly where it should be, which is at 4%. So what they're talking about is our growth is not just like a seasonal cyclical thing. There are a lot of structural drivers. So whether it's digital infrastructure, physical infrastructure, payment technologies, just the ease of doing business in India today, or the fact that we don't, our unemployment numbers are coming down, and even the quality of our fiscal spending. So if we look at the budget, how there weren't any large fiscal excesses going on, how they've stuck to like a consolidation path, and that they're going to continue to do that. And even on the monetary policy side, you see that the RBI is acting ahead of requirement. They're not waiting for a crisis to emerge before they respond to it. I think that's a very proactive and measured way of dealing with the financial system. And that in turn is leading to a stronger macroeconomic as well as a more stable financial uh, system. So what can we expect in 2024? One is that we can expect more FII flows into debt. 2023 was a really good year with only 1 month having negative inflows from foreign investors into fixed income. Now, with your bond index inclusion, there can just be a larger and wider interest and participation in Indian government securities. Then the second thing is, if we look at what we spoke through 2023, we kept talking about how flat the yield curve was. I think this is a year where you can see some level of shaping that can occur, and that shaping will give us investment opportunities. So tracking the shape of the yield curve is going to be key in 2024. And the other commentary that has come in is that corporate spreads narrowed over the last couple of years, and you will see a widening of corporate spreads. It's not necessarily going to be a uniform widening, because those institutions that have cleaned up their balance sheet, come out stronger, are going to get re-rated, but those that have been borrowing at cheaper rates will now have to look at refinancing or coming to a more fair valuation. So this is basically how we are looking at our expectations for 2024. And if we think about how these expectations will translate into allocations, we need to look at maintaining a focus on quality, because in fixed income, there is no compensation for risk, right? If you take too much risk and you don't get your capital back, that's pretty much the end of that story. You can't compensate it with a couple of good investments. The second thing that we can do is to elongate our duration. So looking at a broader range of products, as well as looking at some products with some duration risk. And the third is to balance volatility with participation. So we talked about corporate spreads widening. That could also happen on the government security side, because we talked about a flat yield curve and how the flat yield curve is going to change shape. And whenever you have this shape change occur, there is going to be some market volatility. So finding a way to balance that volatility is through participation. So this means that if you have a certain allocation for fixed income, you need to do it over multiple tranches of investments this year. And you can create layered debt portfolios. So you can have, you should have a more robust portfolio that has different layers that are accomplishing different things for you within one structure. So this is overall how the allocations can look this year. And if we look at our scorecard as Finesse, how we've helped fixed income investors. So I'm going to take a look at what happened in 2023. So we were overweight on short-term funds, we were overweight on high-quality corporate deposits, as well as corporate bonds. The performance has been pretty good for these categories. So you'll see anywhere between 7 to 7.8%. We were underweight on long duration funds last year, and that call also has turned out to be fairly good. Um, in terms of performance, if we look at long duration funds last year, their performance was 6.5 to 7%. This year, or comparative to what we were overweight on, this did uh, not do as well. And we were underweight on arbitrage, which turned out to be not a good call because arbitrage funds actually performed really well. And we were underweight on target maturity, again, similar to long duration. And that has also not really performed as well as, let's say, your short term or your corporate bond fund. So the last part of our presentation is about how we can be your guide to fixed income investing. And just to give you a flavor of Finesse, we do monthly outlooks as well as monthly webinars. So our monthly written outlook, you can sign up for a newsletter, or you can go and read our blogs on the website, which would basically give you a view of how we have been approaching markets month on month, what has happened every month, when our views have changed, what data has caused our views to change, right? And then we, of course, work with investors. And when we work with investors, we help them with product selection, we help them with portfolio construction, and we help them with reviewing their existing investments as well. So with that, I will open up for Q&A. Okay, I see one question already here. Considering a rate cut in future and high run up in Indian equity, can US Nasdaq 100 be a good investment option? I'm already exposed to 70% Indian equity multi cap, planning it to change to 35% in Nasdaq 100. So I think if you look at the Nasdaq, it's actually moved up quite a bit in the last 1 year, and you need to be careful about the entry valuation that you're getting into these businesses. Of course, the Nasdaq does contain the best of US businesses and technology-oriented companies. But is this the valuation that you want to buy at? I'm not so sure that it's a well-managed call in terms of risk management. You should also look at deconstruct the performance, right? What has caused the Nasdaq to really move up? Which stocks have contributed? Which stocks have not contributed? Before you kind of make that call. And more or less, like what we are looking at is taking a lower risk approach because there can be a lot of market volatility. So even in the newspaper a couple of weeks ago, we saw this article which said India VIX at all-time high. You're seeing more and more of valuations being re-rated based on the previous conditions of liquidity availability. This is applicable to both US as well as Indian markets. And in India, there's also this whole India growth narrative that is driving valuations up. So we need to measure both of these and then decide what our allocation is going to be. So if there are any other questions, please type your questions in the chat box. I don't see anything as yet. The Q&A is not loading for me. Gopi, could you just post the question? Okay. Okay, yeah, I see the questions here. Will interest rates go up or down going forward from here on? If so, in particular, which are the types and category of debt funds products to choose and select? So, see, from what we can understand from how the RBI has been talking, I think one is that there is a strong enough real rate, right? So if we look at where we are, our repo rate is at 6.5%, and your last inflation metric, I think, was about 5.7%, right? So you still have almost like 0.8% real rate, which is not bad, but you want to bring your inflation down to 4%. But the inflation trajectory for FY25 is at 4.5, right? Now, at 4.5, if you're going to retain the repo at 6.5%, then you have a 2% real rate, which is quite high. So potentially, if they are successful in bringing inflation to 4.5%, you're going to have rate cuts. But if they are not able to bring inflation to 4%, let's say you have one inflation print reading of 6.1 or 6.2%, then you can't really say that rate hikes are off the table, right? Because maybe you will have to increase the rate to bring your inflation down. But the question, so which is why looking at inflation is going to give you a lot of insights on where the interest rate is actually going. And there hasn't been too much volatility in either the equity or the bond markets in the last year. So any of these numbers coming out of our expected range could essentially give us an entry opportunity into investment ideas across the board. So, what I would suggest is to actually construct a more holistic portfolio and to be prepared for these multiple opportunities that you'll have. So, the next 1 year, if you're looking at adding, say, like a duration kind of product, you need to be willing to participate through this whole year. It cannot be like a one time, today I have these assumptions and I will make a portfolio. You do need to continuously monitor and participate. And that is part of our approach of doing fixed income investing. Okay. So the second question is a multi-asset allocation fund category a strategy of investing style more prudent so in current conditions of overhyped markets and equity rally? So yes, to a certain extent, if you are looking at multi-asset, that does work. And otherwise, what you can do is you can create your own multi-asset portfolio, right? Whether it's with mutual funds, you can choose selective equity schemes which are, say, slightly more attractive in terms of valuations. You can choose some layers of fixed income which would work for you. So it depends on whether you would like to outsource that to a fund manager, or if you're working with a distributor, or if you would like to, then they can help you select the right kind of funds to create an overall multi-asset portfolio. Okay. Also is similarly a style of dynamic asset allocation strategy of equity and debt can also be considered. So again, the real question is like, do you want to outsource that to somebody, or do you want to customize your asset allocation according to your risk profile and your goals, right? Because let's say you do need to have a higher level of allocation towards a particular asset today. You're not going to be able to control that in a dynamic asset allocation fund. Whereas within your own portfolio, if you choose selective schemes, you will have that flexibility. But to each investor, their priorities are different, right? If you feel like it is a headache for you to decide what to manage, when to manage, and you're doing it on your own, probably a multi-asset or a dynamic asset, depending on what your actual requirement is, would work. But if you're working with a distributor or a professional, then it's, I think it's worth sitting down and having that conversation on how to construct your portfolio so that it works for you. Okay. All right, so I see a question with chance of deepening Middle East crisis, crude oil prices going up and inflation is a possibility. Is it a risk to consider higher duration bond? So the beauty of having higher duration bonds is that our markets are actually quite illiquid, right? So no matter what is going to happen, your maybe your yield might change, but for you the return is not really going to change because you're not going to sell the bond. Whatever rate you lock into, that is the rate that you'll end up having because entry and exit in the bond market is a bit difficult, right? But on, let's say, like if you buy a longer duration bond portfolio in the form of a mutual fund, you can see some volatility. And that is the volatility that I've been talking about through the presentation, where you need to have a plan on, okay, if I make this decision today and there is some sort of upward movement in yields, right? What am I going to do at that point? Because my portfolio return is actually going to come out negative. So unless you have an action plan in place, unless you discuss what your action plan is, how you're going to manage volatility, you're not going to be prepared for the opportunities that come in 2024. And we feel that there will be many opportunities this year. So with respect to your NASDAQ 100 question, this is not the right platform. Like we do not advise on specific products. If you do want to understand or if you want to work with us, please get in touch with our team. Like I put our contact details here as well. I have already answered like from an overall risk as well as historical perspective where the NASDAQ is today. So I think your let's say a 2024, 2025 target maturity fund, why would you want to take a target maturity fund at this point, right? You might as well look at a short term, slightly more active strategy uh, at this level. Or if you do feel that that might be better because most of the target maturity funds are like in government securities as well as state development loans, then I think your yield will be close to maybe 7% today or little bit lower than that. Is gold investment right choice in this context? So as a house, we have been talking about the advantages of having gold as part of your portfolio and the necessity to look at that as an opportunity in the multi-asset context. So that also adds into the person's question about should you have a multi-asset or a dynamic asset allocation fund. There are different ways to invest in gold today. I think if you are interested, somebody from our team can reach out. There is a sovereign gold bond issue happening on Monday, so you can participate through that. Alternatively, you could look at a gold mutual fund. That is another option for you to look at, or an ETF, right? Uh, as Fed cut interest rates in coming month. That is the market expectation. But if I just look at what the chairman is saying, I don't think we can take it for granted that there will be a rate cut. Uh, they're trying to be cautious. They're trying to be very balanced in their approach. They're trying to say that if it's required, we'll definitely cut rates. But at this point, the priority is still inflation, and inflation is not at the target of either 4% or 2% as expected. Do we have any further questions from YouTube or anywhere else? Finesse is just our brand for fixed income investing, sir. We do it under ithought MFD, under the Milestones to Wealth program. And ithought, like all of our blogs are on the ithought advisory website. Yeah, there is debt MF, there are bonds, there are corporate deposits. All of these products are available under the ithought MFT platform. And it's only like it's basically only for debt and fixed income. We study structured products, but we generally don't recommend them because of one, either the risks involved or the fee structure, because end to end we have to consider both when we are working with an investor, right? So we don't recommend structured products, but if you do have a portfolio, we can review it and we can let you know what, have a discussion about how that is working for you in terms of your overall goals. For us, the approach is very simple. We don't want to take unnecessary risks when it comes to fixed income. We want investors to travel comfortably to their destination, and we want to use this with all the advantages that come from being safe, right? NCDs are available, sir, but see, the thing with an NCD is that each issuer has certain covenants. The product will be structured slightly differently. So all of those details need to be looked at before you buy. But most investors, what they see is just the interest rate, right? So when we look at NCDs as a house, we study all of these things. We look at maybe the balance sheet of the issuing company, what are their financial ratios like, and then only we look at whether that works for the investor or it does not work for the investor. Yes, we do need to be conscious of credit default risk, and we that is something that we pay a lot of attention to. So we are very selective even in the NCD space. There are many high yield bonds that are getting offered. One of the things that we talked about this in today's presentation was also about how we are expecting corporate bond spreads to widen a little bit, which means there's we need to be a little conscious of when we are entering into a particular investment. Yeah, that's true. Thank you, sir. We'd like to stay in touch with you. Gopi, do we have any other questions from YouTube? Yeah, no problem, sir. So actually, if we think about how the yield curve is structured, right? That is like if I am the Indian government, uh, I am considered to be one of the safest borrowers in the country, right? So for me, the cost of borrowing can be 7%, 6.5%, 7.5%. But now let's say we go to a bank, a top quality financial institution or a bank, their risk is perceived to be slightly higher than the government, right? Or let's say we take a public sector company, then because it has this government, there is some sort of understanding that okay, the government will not allow this institution to fail, or that there won't be a default, those kind of things. There will be some, there is some additional risk that you're taking, right? So you will pay a little, the public sector company will pay a little bit more interest than the government. So similarly, the bank will pay a little bit more interest than the public sector company, or a non-bank financial company, an NBFC will pay a little bit more than the bank, right? So depending on what the perceived level of risk is, there is a difference in the interest payment for the same duration, let's say a 1 year bond or a 5 year bond, uh, of the government, a public sector company, a bank, or a non-bank, or an NBFC, right? So this difference is what we call spread. So if the spread is very less, that means we're saying that all of these different entities, even though they have different risk characteristics, are borrowing at roughly the same rate, right? Which is not normal. Okay, great. I hope that explains the question. Okay. I'll just give it another a couple of minutes. If anybody else has any questions, I'll address them in the chat box. Thank you everyone else for joining us today and spending some of your Saturday discussing fixed income investments with us. These are our contact details if you'd ever like to have a one-on-one conversation, maybe about your investments, or if you have any other queries that did not get answered or that you were not comfortable asking in this forum. Please feel free to reach out to us on WhatsApp, or you can email us also at info@ithought.co.in, and we can get back to you. So thank you. And if you have any feedback for the webinar as well, you can drop that in on WhatsApp.